Welcome to the Value Investor TV podcast. This is the podcast that helps you grow your wealth and become financially independent. My name is Becco, and I have a special guest today, Abhishek. Welcome to the
Thank you.
podcast.
Thank you for inviting me over.
Yeah. So this is part two of two-part episode where we talk about Seritage Growth Properties, a REIT that has a really interesting story going for them, coming off of as a spinoff of Sears and as a REIT, undervalued assets. That's kind of the story we're talking about here. But before we jump into the meat of the story and in the second part of this podcast, if you haven't listened to the first part, please do, because that provides a lot of context to what we're going to talk about in this episode. In this episode, we're going to really focus on the management, the balance sheet. How does that look like? And then ultimately, we're going to run through a valuation exercise. So, if you guys haven't listened to the first part of this Seritage episode, please do before listening to this one. And just a quick shout out to Abhishek, who is a special guest to the podcast. I extended an invitation. You guys probably heard if you listened to the first episode. But I extended an invitation to Abhishek to come onto the podcast because he has done this thorough analysis and shared with our Slack community, right? And his analysis was quite good, and so I invited him onto the podcast as a way to encourage everyone else who is in the community to do the same, right? Pick a company that that you like, and try to dissect it, understand it, and figure out what is their story, right? This is really a story exercise. So I hope this podcast, and I hope Abhishek can be an inspiration for people to do the same. And again, just a quick housekeeping items, a couple more housekeeping items. If you guys want to be part of the Slack channel where Abhishek posted this awesome report, please reach out to me at info@valueinvestor.org, info@valueinvestor.org. And we're also going through a checklist. So if you like a checklist, please reach out to me also at the same email address, info@valueinvestor.org. Okay, enough about the housekeeping items. Let's jump right into the checklist. So in this episode, again, we're going to talk about the financials, the management, and valuation. For those of you who so we're going to talk about those three things. So Abhishek, if you could quickly summarize what we talked about in the last episode before we do talk about these questions, I think that would be great. So I'll toss it to you.
Yeah, so Seritage is basically a mall REIT or retail REIT that holds underlying assets that were spun off from Sears. And I believe that the market is not willing to value these properties for the price it should. And while they are going, and it's difficult to value them because they are going through this big transition of recapturing these properties, redeveloping them, and releasing them. And what market thinks is it's very unlikely that Seritage will be able to do so. But when you deep dive into these properties and the way they are doing it is very interesting to know for everyone that they're basically able to sell the assets, some of the assets, to fund the capital investment that is required to develop the crown jewels or the remaining properties.
Yeah, excellent. So let's go to kind of these subsequent questions about the balance sheet. Basically, these series of questions that we're going to ask here are really related to the health of the balance sheet. So the first question: does the company have enough cash to maintain its business? And I think it would be good to lump this question with a second question, which is: does the company maintain reasonable debt level? I ask this because I think a lot of people, when you look at this company from the surface, people get scared away because of a huge amount of debt on their balance sheet, right? So if you could talk about that, that would be great.
Yeah, so the current revenue comes up about $97 million from the properties that are currently being leased. Their operating expenses on these properties is about $60 million, and overhead expenses are about $40 to $50 million. Other than that, they have a debt of $1,600 million, and which has a 7% interest of about $112 million. Now, the interesting part over here is that these are triple net leases. What a triple net lease means is that tenant, after the space is leased, tenant pays for all the maintenance, redevelopment, and all the taxes that the property holds. So what that means is once the property is leased, the rent that is coming as a revenue directly slides down to the bottom line after the overheads are paid for. So the operating expenses Seritage is right now paying about $60 million will drastically reduce once the properties are completely redeveloped and released.
Yeah, that makes sense. And can you talk about the cash and the debt level?
Yeah, so they have about $120 million of cash as of quarter 3 of 2020, and the current debt level is about $1,600 million. They have an interest of $112 million that they are able to fund through the cash that they are getting from sale of assets. But they, like I said in the first episode, they have been able to amend this contract, which is with Berkshire Hathaway, to defer the interest payment if the cash levels were to go substantially low.
Hmm. And when was this amendment done?
I think it was in quarter 2 after the pandemic hit.
I see. So this is maybe just my naivete, but why would they not take advantage of that?
I think it's basically because Berkshire basically wants to back this story, and Warren Buffett is also personally invested in this company through his personal portfolio, and this term loan is provided by Berkshire. So I believe they are being more lenient towards Seritage, and they believe in the upside the Seritage can essentially provide.
Hmm. I think that's actually an interesting sub story that you probably should talk about, which is that this company is actually invested by several heavy hitter value investors. So if you could talk about some of them, please.
Of course. As we all know, Eddie Lampard himself is a great was a great investor and is a major shareholder of Sears as well as Seritage. In addition to that, Warren Buffett owns a 5% stake in this company when the company was spun out in 2015. Recently, Mohnish Pabrai bought about 12% stake in the company after the pandemic when the share price dropped from about $35 to $8 a share. And additionally, Guy Spiers added on to his position as well at the same time. And he owns about 1% stake in the company. Moreover, if our listeners know, Phil Town also owns some of the stake in the company as well.
I see. And do you know when they started buying the company?
Yeah. Monish actually had bought this company back in 2017, but he was waiting for Sears to survive until certain time, and then he sold off. And then he bought again in quarter 2 of 2020. Guy Spier added on to his very small position in quarter 2 of 2020 as well. And I believe Phil Town added at the same time.
I see. That makes sense. Okay. So enough cash, and obviously they're being financed by Berkshire Hathaway and Warren Buffett himself, and it looks like they're securing these deals at a very favorable term. So having enough cash doesn't seem to be an issue when it comes to expanding its business, making sure that capex is being met. In terms of debt level, they are paying 120 million in interest rate, and that should be they should be able to service that off of the new off of the revenue that's being that would be generated in the future with these future properties. So that's the idea with cash and debt level. Okay,
Yeah.
so the next question here is let's go to the free cash flow. So does the company generate a strong amount of free cash flow from operation? Right. Very, very important, I think, in the fact that we are in this phase of the company where they are pumping a lot of money back into the business, right, in the form of capex. So how does that look? free cash flow.
So interestingly enough, they don't. They don't generate enough cash. Like I said, $97 million of rent. They have about $100 million of operating expenses plus overheads right now, and they're basically trying to pay the interest through the sale of properties and fund the capex. So in a sense, they don't. But they have about 4 million square feet of properties that is ready. It's also leased. It's waiting for tenants to acquire the space and start paying rent. That would be equivalent to additional $70 million of rent that can be generated in next 12 to 18 months. So while we are in this pandemic and everybody's trying to figure out their business development plans, these properties once acquired will start paying the rent. And additionally, they are not waiting for the redevelopment. They are blowing and going by using all the funds that they're getting from sale of assets to fund the redevelopment.
I see. Makes sense. I guess the risk here is that the tenants don't show up soon enough, right? Is that a real
Yeah.
risk?
Uh, I would say yes and no, because while some of the spaces for retail and mixed use, many of the retail that is getting developed in next 2 years is basically residential. They have about 5,500 apartments that are coming online in next 2 to 3 years, which stabilizes and diversifies their cash flow. Apart from the $165 million that is likely to get generated, that is signed lease, right? So basically, um, I feel more certainty towards stabilization of that cash flow.
Because the fact that the mix of the real estate portfolio you're talking about here is partly residential. And what is the
Yeah.
percentage of the upcoming properties that are up for lease that are residential?
It's about let me see. So the mix will be about 30%. 30 to
30%.
35% will be residential once fully developed.
I see. And is there any worry that, the flight out of big cities, right? New York, San Francisco, where are these residential properties located?
So these are exactly where Sears are at, and they are mostly in California and Florida. So one of the big there are three big projects that were announced. One was in Florida, one was in California, and one was in Chicago. That sums up 5,500 apartments.
I see. Do you worry about, I guess, is there any risk in terms of those also not being fulfilled within a reasonable amount of time?
So it kind of depends, right? But the value of the property doesn't really depreciate. And one of the good example of that is they in this last quarter, they were actually able to sell some of the income generating properties at 10 times the rent. So for example, there was a million square feet that was renting about $15 million, and they were able to sell it for $167 million, right? It was not even generating rent, it was just signed lease, and another developer decided to buy the property, right? So even if they develop and make everything ready, they can find buyers to get the property bought out, which
So,
and I think, yeah.
mhm. so the story here is that in the short term, the cash flow is negative, and it is going to turn positive, and in a short while, when these new properties get on the market and people actually live there or start businesses there. The question here is a timing aspect of all this, right? The bet here is that when they put these properties out in the market, people will come and people will buy these not buy them but lease these properties. But even in the worst case possible scenario, right? People don't show up. They don't want to lease at these properties. The worst case scenario, from what you're saying, is that you can at least sell them. You can sell them,
Yeah.
and that would help in terms of servicing, in terms of bringing more money into the business, top
Yeah.
line.
Yes. And that's the key, right? It's highly uncertain, and we'll get to the point of it. But to the traditional investor or financial community, it does seem very very risky and certain. But a lot of people find it difficult to to differentiate between what the real risk is versus what the uncertainty is. And I
Hmm.
think the story here is that these properties are valuable enough to service the debt, but when and how is the story to be unfolded.
Hmm. Makes sense. So the bull case we talked about all along, but the bear case is that no one's going to show up. COVID-19 is here to stay. Pandemic is here to stay. No one's going to be buying real estate properties, commercial or residential. Uh, Maybe that's kind of a too extreme case, but the demand is not going to be as robust as it used to. Therefore, rent is going to go down, the property value is going to go down, et cetera, et cetera. That's the bear case, right?
Yeah, and even with that bear case, it seems like even if you sell these properties at liquidation value, they might be still be able to service the debt and still have some remaining equity.
Makes sense. Okay, great. Let's move on to the second part of this podcast, this episode, which is talking about management. With REITs, it's not necessarily super important, I don't think, just because of the fact that you have to push out a lot of the earnings back to the short. I think it's 90%, right? 90% you have to push it back out. So it's not as important as some other forms of company, but I think it's still certainly worth mentioning, especially coming from the fact that this is, there's a strong kind of value heritage of company of people who are owning this company and running it. So let's talk about this really quick. Is management properly incentivized to protect shareholders' interest over its own? So
So
usually,
I actually
Mhm.
I actually went through management compensation for every year, and they actually highlight performance highlights that
Mhm.
they achieved every year, right? And if you make a summary of it, it's basically in two spaces. You are supposed to basically sell the properties, get the money, do the development, and lease it, right? And for all 4 years from 2015 to 2019, they were able to successfully do that, and that is how their compensation is decided. Now, another interesting point is that Sharon Osberg, that I would like to mention, is very close friends with Warren Buffett. I believe she was a partner, partner in one of the bridge tournaments as well, and she has served in Sequoia Fund as well as at a top executive level for Wells Fargo as well. So she decides, or she leads the compensation committee for Seritage, right? And I could see a very realistic decision making on that, because the moment pandemic hit, management salaries were cut by 25% and CEO salary was cut by 50%. So it seems like management is aware of it, and they are taking necessary steps to maintain the cash flow and keep the business solvent.
Fantastic. Fantastic. Okay. I think, this question, maybe it probably is very premature to talk about, but I'd love to get your thoughts on this. Has management handled excess capital in a shareholder friendly way? So like buybacks or dividends. Obviously the company's still kind of thinking about, you know, how do we make it cash flow positive and things like that. But what is your take on this?
So they were paying dividends until 2019, until they realized that they have to maintain certain cash. So to adhere to the rules of REITs, they were paying the dividends usually, and basically all the money is basically used to capex, which is a requirement in the best interest of the shareholders, in my view, to get more and more properties online and release them.
Hmm. Okay, that makes sense. Um, the last question here: management open and honest? Is management open and honest? I feel like from the vibe that you're giving me, information that you're giving me, strong, most ethical kind of compass. I would say yes to this question. But what is your take?
I do want to bring up two interesting points here. This one's a little tougher. So I think management is very transparent. So like when the COVID hit, you can go online and find a CEO's letter explaining what they are doing, how they are managing the cash levels, what they are doing internally as well as externally to go through this period. So I do believe that the management is very transparent. However, there have been latest news as early as 2 weeks ago that CEO of the company has decided to move into another company, as well as CFO, which is a month ago. And I believe this is a big news in terms of why it would happen, and in terms of this whole thesis, right? But when I think about it from shareholders' interest, right? I believe that's the right move to make if the management is not willing to serve its shareholders and decides to go to some other company. And I believe this is where Sharon Osberg might have come to the position and say, "Hey, I'm sorry, but I cannot keep up your salaries, and our salaries have to be cut." Right, which seems reasonable given where we are, and to think from management's perspective in terms of CEO, if he gets better offer, that seems fair to him as well.
I see. So the reason why so this is kind of a big news, right? The CEO and the CFO leaving the company to transition over to another company, right? And so you think that the reason they are moving is because of the salary cap that the board has imposed on the executives.
I believe so. So, company, if there is anything, company has not brought in any attention to any of the events that might be going on. Uh, so it certainly seems like they want to say everything's nice and green. But then we know that their salaries were cut. And if they have better opportunities, I think they're fair to take those advantage of.
I see.
Yeah,
I see.
I do want
That's
to add that
mhm.
it seems like potential CEO from my research could be Kenneth Lombard, who is current executive vice president as well of the company, and he has been with the company since the beginning. There's a lot of news coming around it, I guess, and it's not finalized, and there is no news from the company. But having an internal CEO could be very well placement, given the fact that they understand the business more than an outsider.
Yeah, that makes sense. So bringing in somebody who's internal and promoting within.
Yeah,
Okay, that makes sense. Let's move on to the most interesting part. One of the most interesting parts of this is, which is the valuation, right? As we talked about it in the top of the podcast, this Seritage Growth Properties really is about the story of value investing, right? Looking at the balance sheet, this hidden assets, and figuring out whether the assets that are sitting on balance sheet is worth more than what people claim to be, what the market claims it to be. Um, so let's why don't you walk us through your analysis, and also talk us through your margin of safety, and the finally the price
of
that
course.
you would be willing to pay for this company.
Yeah, so given the current potential of about $100 million of rent and maybe another $70 million coming in online, I believe they will be able to remain solvent and maintain the cash levels with the debt amendment. Looking into the upside, I believe that they would sell off about 10 million square feet for about 800 to 900 million. Use that to fund the development, increase the annual rents to up to 200 million from maybe 165 in next 3 years. That would allow them to get additional debt from the credit facility that Berkshire has, and keep that in the development, right? But in the long run, the interesting part is that they have about 20 million of undeveloped space, which is going to require about $2.7 billion to be funded, right? And portion of that will have to come from the debt. So let's say out of 2.7, $1,200 million come from this additional credit facility and the sale of assets. The remaining $1.6 billion or so will have to come from definitely an additional debt, right? So the total debt is likely to increase from current level of $1.6 billion to $3.2 billion. Now, the interesting point that I brought earlier is that once these properties become cash flow and stabilize, they can and they should be able to do the refinancing at a mortgage level. And there are two examples that this has happened in the past. One is the Washington Prime Group, and another is Alexandria. They were in this midst of transition, and they were able to refinance these properties at a lower interest. Now, with that, their annual rents are likely to go from current levels of 97 million to say 540 million over the next 10 years if they are able to develop all of its portfolio. And uh, and that allows net operating income to increase up to 360 to 430 million. Think about it this way: once the properties are developed and leased, these are triple net leases that allows only overhead and some of the maintenance capex that they would have to do. Other than that, the rent comes straight to the bottom line. If that is where to happen, about 360 to 430 million of net operating income should bring the enterprise value close to $7 billion with a cap rate of 6%. And if you subtract the debt of 3 to 3.55 billion dollars, the equity should be worth about another $3.5 billion, right? And that translates into 50 to $57 per share, given that they dilute the equity by 20%. So, for example, right now the shareholder share outstanding shares are 55 million. I anticipate them diluting that to about by 20% to $67 million, and $3.5 billion will be worth about 50 to 55, $57 per share. The interesting part about that is that while this is an upside, as a value investor, I'm not willing to believe this story just yet because it has a long time horizon, right? So my margin of safety lies in the fact of what happens by 2024, right? There is because there could be a potential risk of Seritage not be able to get more debt that they need to fund the development. So let's talk about what happened up to 2024, or what can. They use the 800 million from sale of assets. Then they get the $400 million from Berkshire to get additional rent of only $150 million. So the annual rents would go up to 300 to $310 million. NOI margin for these properties would increase to about 70 to 80% to generate net operating income of about $230 million. And with a cap rate of 6 to 7%, this should bring valuation to about 3.5 billion. You subtract the $2 billion debt that they would have by then, the equity is still worth $1.5 billion. Current market cap is about $800 million, which shows like 100% upside. uh, so that's why I believe there could be a potential upside to about 28 to $30 a share. And right now it's trading at 40. So I'm not even willing betting on the horses that is likely to happen. I'm just willing to wait, hold, and see what is likely to happen in next 2 to 3 years and how they perform during that. So it's more or so low risk but a very high uncertainty bet. And I think that's where I was interested and intrigued to get into this. And I think this is Monish's style of investing, as he mentions in his book. And it was hard for me to even understand all bits and pieces until I went through the full analysis and see the potential of it.
Excellent. Yeah, so that makes sense. So you're talking about the most rosy picture of, that's the first thing that you talked about, and then there's kind of the not so rosy picture, but more realistic picture in the short term. Even then, you're giving it 100% upside from here. Right now, as you mentioned, what is it trading at?
It's
Seritage.
trading at $14 a share or so.
I see. Okay, great. 14, yeah, $15 as of today. Today is the 20th of December, and that's trading at 15 $15, and the market cap of about 550.
That's not actually accurate. I do want to highlight to it our users that they have operating partnerships. If you go to their annual report, they
Mm-hmm.
have operating partnerships which are convertible, and when you add those additional shares, it goes to 55 million outstanding shares, which makes the market cap to about 800 million. Then.
800 million.
Yeah,
Okay. Okay, great. All right. So you're saying the right now in the most realistic case, it should be two x upside. I don't think, we are almost at time for this podcast, but if people would like to do a more deep dive and understand more in detail of analysis that you have done, I know you run a blog, so we'll definitely link that in our description so that you can go check that out. Some of the detailed analysis that he has done would be available online after we record this podcast. So please go check that out. And if you want to engage with Abhishek directly, I'll also paste his Twitter handle in the description box as well. Okay, so that brings us to the end of the podcast. Anything else you want to talk about?
Yeah, I think, like I said, Seritage is an interesting story where you're supposed to, where I wouldn't necessarily make a huge bet, maybe a small position, and kind of like see how the risk unfolds or the uncertainty unfolds. But it's an interesting story where you can actually think about how the big investors might be thinking about this. Wrapping it up there. I just wanted to kind of like thank you for having me over here. I'm super grateful for you to give me this opportunity to bring my analysis to the table. And I do want to encourage people in the community as well as our listeners to do such deep dive and bring some of these insights onto the table. And on a personal level, I do wanted to thank few people. Because of their research, I was able to put this together. So Brad Kellner, he has a YouTube channel who did individual property analysis for Seritage's growth properties. And then there are two more people. There is a channel called Investing with Tom, and then Karan Gurnami. So I would like to thank these people for doing the meat, I would say, of the analysis and allowing myself as well as other readers to dive into this more deeply. And to just close the statement, yeah, I'm trying to learn this on my own. I'm trying to professionally learn this as well. So feel free to reach out to me if you have anything.
Excellent. Awesome. Well, it's been a pleasure having you here, and I hope more people can come and talk about their thesis for a company that they enjoy and they're really excited about. So again, thank you for coming onto the podcast. All right, that brings us to the end of the podcast. Thank you guys for listening in, and I hope to see you guys in the next episode.